Now that we're into earnings season, stocks that are releasing their earnings reports are front and center on the radar screen for day and swing traders. Hi, I'm Seth Freuberg, the head trader of SMB Capital's options trading desk here in Manhattan. And the guys on our trading desk utilize unique strategies to take advantage of the way that options respond to scheduled earnings releases. In this video, we're going to take a look at a very interesting strategy, which involves a trader establishing a position in a call option on a stock coming up for earnings without any cash outlay at all, so that if the stock does rally off of earnings, the position can explode in value with a minimal use of margin. So if this sounds of interest to you, then stick around because I think you're going to find this eye-opening. Hi, I'm Seth Freuberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. Okay, so one of the traders on our desk recently asked me to provide him with some ideas for how to take advantage of a potentially explosive move on a stock coming up for earnings, on a stock that he follows closely, which is Bed Bath & Beyond, with the ticker symbol BBBY. And so what I suggested is a similar concept to what we'll be discussing in this video, which is a certain option strategy that allows a trader to acquire a call option without any outlay of cash and actually very little risk, but the potential for a really large win if the market really responds strongly to an earnings report. Now, in order to discuss how this trade works, we need to make sure that everyone watching this video understands how stock options work. For those of you familiar with the stock options, this is going to be really quick, so hang in there and we'll get right back into how the strategy works right after this quick review of the basics. Okay, so what's known as a call option on a stock entitles the buyer of that option to purchase 100 shares of that stock at a certain price called the strike price of that option, regardless of what price the stock is actually trading at any time before that option expires. What's called a put option, on the other hand, entitles the buyer of that put to sell 100 shares of a stock he owns at the strike price of that put, again, regardless of what price the stock is trading at any time before that option expires. The buyer of the option pays what's called a premium to the seller of the option because the seller of the option is taking the risk that the stock will go past the strike price of the option, in which case the buyer can exercise his option. So in the case of a call, even if the stock has gone way above the strike price of the call buyer can exercise his right to buy 100 shares at that strike price. In other words, he's entitled to buy the shares way below market. He could flip them, for example, the next minute and make a huge profit on those shares in that case. And so at earnings time, this becomes a huge risk for the call seller because if this happens, in other words, if the stock rallies hugely off of earnings, then he'll have to sell his shares for much less than they're worth. And so taking this risk near earnings requires him to increase his charge for those calls to cover that larger risk. Or conversely, on the put option, even if the market goes way below the strike price of the put option, the buyer of that put option has the right to sell his shares of that stock at the strike price of the put option that he's bought, even if the stock price has gone way below the strike price of the put, which effectively puts a floor on how much he can lose owning that stock. And so again, this represents a huge risk for the put seller if the stock tanks after earnings and the put seller is required to buy the shares at much more than they are worth, taking an immediate markdown in his account. On the other hand, if on expiration day, if the stock closes below the strike price of a call, unless it was previously exercised, the call expires worthless and the call seller just pockets the premium. Similarly, if you're sold a put and the market closes above the strike price of that put, then unless the put was previously exercised, it expires worthless and the put seller just pockets the premium. Okay. So for an example of how this earnings strategy works, let's move to late in the third quarter of 2020 to 3:30 in the afternoon on Wednesday, September 30th, which is the final trading day before BBBY releases its most recent earnings report. And as you can see, BBBY had recently bounced from the 4 area in the summer and was now trading at around 15 the afternoon before earnings. So suppose on that day, the trader bought 10 of those 17.5 calls and simultaneously sells 10 14.5 puts and buys 10 of the 14 puts, all expiring in 2 days, the day after earnings are released. Well, to an options trader, this is actually a very interesting way to play BBBY earnings if and only if you're bullish on how the stock will react to the earnings release for whatever your reasons are. Now, before we get into exactly why this is such an interesting bullish position using options for BBBY as it's coming up on earnings, I wanted to let you know that if you want to learn the details of 3 additional option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, or the options income strategy that allows you to make consistent money whether the market goes up, down, or sideways, and how to make money on a stock or index trade even if you're outright wrong on the direction of the stock, then just go ahead and click the link that should be appearing now at the top right corner of your screen. That's going to open the free workshop registration page in a new window, so don't worry, you won't lose this video. Or you can go ahead and register directly for free at optionsclass.com. Believe me, you don't want to miss this, so pause this video, sign up now, and then resume watching. Okay, so let's break down what's going on here, and let's first look at this from a cash flow perspective. So you'll see why we're actually entering this position with positive cash flow into your account. Okay, so let's start with those 14.5 puts that we sold. And you'll remember those went for 85 cents. But remember, each options contract relates to 100 shares of stock. So you multiply that price by 100, and we bought 10 of them. So the resultant cash flow from the calculation, as you can see, is $850. And simultaneously, we'll be buying those 14 puts for 60 cents, which, as you can see from the calculation, costs $600. Finally, and really the key to this trade, are those 10 calls that we bought up at 17.5 for 23 cents, resulting in a cost of $230. So the first thing that becomes glaringly obvious with this trade is that we're actually receiving $20 of cash into our account when we first enter it. However, you should be aware that this trade, for reasons we can get into another time, will require you to have at least $480 into your account to implement this trade. And in fact, $480 is the worst case scenario for the trade. It can't get any worse than that, which would only happen if the stock were to go down after earnings. Now, before we get into how this trade turns out, I wanted to point out something interesting, and that's the fact that if you think about it, the strategy has a built-in kind of wiggle room in it. In other words, think about it. If you simply went long the shares of stock, then unless BBBY rallied after earnings, you'd obviously lose money on the trade, right? So you're long shares and they go down, so obviously you lose money. But with this strategy, for $480 of margin, as long as the stock didn't drop below 14.5 after earnings, you would at least make $20. So for example, let's say that BBBY after earnings dropped to 14.60 and expired there on October 20th. Well, in that case, if you analyze it, the 17.5 long calls would expire worthless because the stock closes below 17.5, but both the 14.5 and 14 puts would also expire worthless because the stock closed above those puts, and so all of them would expire worthless, and you just pocket the $20 you got at the beginning of the trade. In fact, at any price above $480, the trade makes at least $20, which is a 4% return in 2 days, which is hardly terrible when it would take you more than 2 years to make 4% on a 10-year treasury bill, for example. So it's not like it's nothing. It's actually a meaningful return in context. However, we obviously aren't going to risk $480 if the best we expected was to get $20 out of the trade. We're obviously looking for a lot more in a trading situation. So if we now move forward to the day these options expired on October 2nd, you can see that the market obviously was happy with BBBY's earnings release, and the stock rallied more than $5 during the 2 days since earnings. And so now let's break down the outcome of this trade. Well, if you took assignment of the shares, then that would be 10 options times 100 shares per option. So you'd own 1,000 shares valued at $20,600. And as you can see from the calculation, those calls entitled you to buy those shares at $17.5. So you'd have to subtract that cost out to get the profit picture. Now, both the short and long puts also expired worthless because they have no value below 14.5 as we discussed. And remember, you got that initial $20. So when you net it all down, it comes out to a profit of $3,100, which isn't exactly a 650% return on the original capital requirement of $480. Now, before we wrap up, I wanted to cover one more important concept. Now, suppose that instead of taking our $480 and using it for that option structure I just showed you, what if instead we bought 32 shares of BBBY that day for $15 per share? Well, first of all, that would eat up the entire $480 if you do the math, so that would be the most that we could buy. And suppose that the stock rallied to 20.6 like it did. Well, in that case, as you can see from the calculation, you'd make $179.20 versus the $3,100 we would have made with the options transaction. But suppose the stock actually dropped to $14.60. Well, the shares would obviously have lost 40 cents per share, so that would be a loss of $12.80, while the options transaction would have expired with no value, and we would have actually profited $20 as we mentioned before. Now, if the stock were to drop too much further, then you would have been better off owning the 32 shares, but then those 32 shares never could have given you the explosive upside potential that the option structure did, and that's very important to realize. So to a trader, the risk reward of the options trade was massively more attractive than the 32 shares of stock. So what I'd like you to take away from today's trade example is that once you start thinking like a professional options trader and are able to intelligently explore your alternatives to just flat out buying shares around earnings, a whole world of options trading strategies opens up to you that you can leverage to get into these amazing risk-reward trade-off situations that give you huge upside without a meaningful downside risk, and as an added bonus, a wide range of outcomes over which you are assured of some profit, even if your trading thesis turns out to be a little bit wrong, as we just illustrated. Now, just to remind you, if you're serious about your options trading, you need to check out the free intensive options class that we're currently running, where you'll learn 3 real-world option strategies that our professional options traders use all the time. So just click the link that should be appearing now at the top right corner of your screen, or you can just head on over to optionsclass.com to register for this free workshop directly. It really is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now before you miss it. And please don't forget to hit our subscribe button right now so that you don't miss any of our free training videos to help you to improve your game as an options trader.